Welcome back. Well, quarter 2 FY25 was a good quarter for Samhi Hotels on the back of strong operational performance and lower finance cost. To discuss this in detail, we have Ashish Jakhanwala, who is the Chairman, Managing Director and Chief Executive Officer of the company, joining in now. Ashish, good afternoon. Thank you so much for joining in. Well, it's been a good quarter for you in terms of operational performance. Can you give us a sense of your FY25 revenue, EBITDA and finance cost target, because finance costs led to better profitability this time? And what is the rate at which each segment is growing, be it medium, upscale or upper scale as well?
So thank you so much. You're absolutely right. We had a strong quarter two. Actually, if you see both quarter one and quarter two, revenue available per room grew upwards of about 13-14% in our portfolio across all the segments. For quarter three and quarter four, we expect to maintain similar growth rates in RevPAR. All of our core markets, which are largely the key commercial centers in India, continue to have very strong demand from business travel. So we expect to maintain that, I would think, early teens RevPAR growth across our portfolio. We're not giving any specific guidance in terms of revenue and EBITDA towards the end of the fiscal year, but we do maintain a double-digit growth rate on revenue.
Double-digit growth rate on revenue. Now, coming to the important part of your portfolio, analysts were waiting for a turnaround as far as the ACIC portfolio is concerned. What is the update over there? And in terms of operational efficiency, can you give us a few targets that you've set for yourself by the end of FY25?
We acquired ACIC in August or September of last year. And if you were to see the first half of FY24, this portfolio had a margin of about 30-31%. As of the last quarter, we've reported a margin of 36% in ACIC. Our broader portfolio is at about 40% EBITDA margins. And we do expect that by the end of this fiscal year, ACIC would have gone to touch that circa 40% EBITDA margin. That's only part of the story, right? The second part is what we are doing in terms of enhancing the revenue potential of these hotels. So of the 6 hotels we had acquired, we've signed management agreement with Marriott for them to be managed by Marriott now. And therefore, we expect 4 of those 6 hotels to start seeing better revenue generation, largely on account of improved average room rates. But the other 2 hotels, the one in Pune and one in Jaipur, we're actually expecting them to be completely repositioned as we rebrand those hotels. So ACIC's true value is going to be leveraged over the next few quarters. The first is through margin expansion. The second is going to be through improving the average room rates in that portfolio. And the last bit is going to be through rebranding of 2 of the 6 hotels, where we've always seen material uplift.
Okay, so once that does happen, more rebranding and better margin expansion, what will the consolidated margins look like for your business overall? Because the margins have also been improving.
So EBITDA margins, we are targeting to be upwards of 40% on a sustainable level across the portfolio.
And will we see further cuts in finance costs as well?
So we have seen constant reduction in our interest rate over the last 4 quarters. We still think there's significant headroom for us to lower our cost of financing. So absolutely, you would expect some reduction in financing cost over the next few quarters.
Ashish, last question from our end. Number one, any update as far as the Navi Mumbai land bank is concerned? Any asset you're evaluating in Mumbai? And other than that, recent acquisition, Bangalore, Hyderabad, CapEx as well as timelines as far as turnaround is concerned?
So Navi Mumbai status quo. We actually don't have any change there. We would probably pursue the matter with the administration post the elections. In terms of Hyderabad and Bangalore, of course, that's a very exciting addition to the portfolio. We've added almost the potential to add about 500 rooms to our portfolio. But even more than that, it's important to understand that all of them is going into upscale space, where the revenue per key is almost twice that of the portfolio average. So these 500 rooms hypothetically have the impact of almost adding 1,000 rooms to our portfolio, which is about 25% growth. Now, if you see, there are 3 hotels in that whole acquisition bucket. One is operating as we speak, which is in Bangalore. We will rebrand this hotel in the next 18 months. The second would be the high-tech city, where we've actually taken an office building on a long-term lease. And this would be converted to a hotel and be ready to open in the next 18 months also. And the last bit is the new tower in the Bangalore Whitefield development, which will take about 36 months. So you would actually see these 3 acquisitions creating an impact on Samhi starting FY27, going up until FY29.
Okay, all right. Take that point. Thank you so much for joining in today and giving us all those details, Ashish. So that's the word coming in from Samhi Hotels. The stock is higher, up around 2% as we speak. And again, as CNBC TV18 celebrates 25 years of excellence, we invite you to the most anticipated event of the year, the CNBC TV18 Global Leadership Summit on November 14th, starting 10 a.m. onwards. A power-packed day with several panels focusing on India's economy, digital landscape, markets, entertainment, and a lot more. Only on CNBC TV18.